So, following 2 consecutive quarters of negative GDP, which is literally the definition of a technical recession, it seems that things are about to change. Now, the US Department of Commerce is going to come out today and publish the Q3 GDP figures, and the expectation is a positive 2.3%. Now, that's going to be huge because we just had a negative 1.6% in Q1, a negative 0.6% in Q2. But does this mean we get to celebrate? Well, the politicians and mainstream media will tell you, sure, go right ahead, celebrate away. The same people who told you that 2 negative quarters of GDP is not a recession will now ironically use the opposite argument to claim a recession is not going to happen. Just my head just exploded. But basically, the question is, without this joke, will they be right? I mean, is this actually the end of the recession fears for 2023? I mean, if the GDP is growing again, that means that a recession is not happening, right? Well, not so fast. Let me show you what's actually going on underneath the hood using multiple data points, not just fluff. Look, one thing to realize about GDP is that it's not something you will hear from mainstream media, but it's a statistical model. And, any statistical model, like the GDP calculation, it has a lot of flaws and skews. I mean, it's a known thing. One thing that happened in Q3 was a drop in imports, which actually narrowed down the trade deficit we have and increased GDP calculation. But actually, it's a negative indicator because when we have less imports, it's actually showing a drop in local US demand for imported goods, which is a clear sign of trouble, not a positive sign. So that's just one example. But beyond that, look at what's happening with big tech this week, and specifically at Google and Meta. They both reported earnings. This is very interesting. Both of these companies dominate the advertising business like no other. Google has a stranglehold on video ads through YouTube, while Meta and Google run the show as far as social media advertising. You could say they pretty much own this industry without little to any competition. Now, this week, Meta stock crashed 20%. That happened yesterday. Google stock crashed 10% 2 days ago, both due to weak earnings. Now, Microsoft did okay in their earnings, but had a weak figure as far as guidance. They also dropped 8%. And next, we have Apple and Amazon, probably going to be very, very similar. Now, look, I think that despite the GDP forecast I just mentioned in the beginning of this video, this is a major canary in the coal mine moment for the economy. Now, for those of you who are not familiar with the idiom, yes, that's how it's called. Up until 40 years ago, coal miners used to take canary birds with them every time they went down the shaft, down the mine. And because canaries are more sensitive to dangerous gases, at least more than humans, so if the canary died, the miners knew they got to skedaddle right out of there. Now, obviously, this was not so humane. In 1986, this practice was abandoned. It was banned because obviously, it's not cool killing birds for that. And they basically replaced it with electronic detectors. And that doesn't really happen anymore, but the idiom caught on and now still widely used. So let's use Google as the test case here, and let's see how Google earnings are actually a canary in the coal mine, with the coal mine being the US economy, of course. Now look, Google posted Q3 earnings and they missed both on top and bottom lines. Similarly to Facebook, by the way, who also missed earnings on the same week. Now, Google's revenue for the quarter was $69 billion, which in itself is kind of a funny thing. It's actually up from $65 billion just a year ago, but way under the $70.5 billion they were expected to make. Now, they also missed EPS, earnings per share, with 1.06, down from 1.4 just a year ago and well below the expected $1.25 per share. Revenue growth also slowed down 6%, down from 41% last year. YouTube revenue actually went down, shrunk by 2% to $7 billion. Now look, this wasn't a quarter to write home about, but it was actually a pretty solid quarter, especially considering the rising dollar, which took a toll on their numbers, their global business. Now remember, Google is still making money and is still growing. It's a terrific company with barely any debt, sitting on a quasi-monopoly in the video ad industry, a great cloud business, and a myriad of other income streams, plus a huge pile of cash, more than $100 billion. So I say their earnings scare me. Yes, that is true, but I'm not talking about Google, the company. As a company, they'll be fine. And as an investor myself, I'm not even worried at all. I'm talking about the economy. Google is going to still be a top-tier stock over the next 5 years, and it's good enough for me as an investor. But I'm alarmed by these earnings. But if Google is doing okay, what is really going on here? Well, look, the fact is that Google and Meta, as I mentioned earlier, they pretty much the only game in town without any real competition, and that's important. If you want to kind of run any sort of non-broadcast TV campaigns as far as advertising, you got to work with either or maybe even both Google and Meta. So when ad revenue goes down for both at the same time, it's not about them losing ground to competition. It's about a closed circuit. It's about less money being spent on ads in general in the market. You see, even with the strong dollar neutralized, and it's not such a huge thing as people like to make of it, Google and Meta made it very clear based on their earnings that companies, their clients, are spending much less on ads this quarter. And no, the decline in ad revenues is not due to people installing ad blockers all of a sudden on their browsers. Those have been around for over a decade, years, never really made a dent in the revenues. Now, if you look at the flip side, you're going to find out something really interesting. Companies are spending less on advertising because people have less money to spend. And as a result, they're buying less stuff. Look at the data. Don't just take my word for it. I urge you. Now look, the personal savings rate in the US has dropped from a record of 4.8 trillion just 2 years ago at the height of the stimulus checks, all the way down to 628 billion right now. That's an 86% drop in US consumers of money they have saved up. Let that sink in. 86% less savings than 2 years ago. Now here's what's going on right now. Inflation is still super high, about 8%. People don't have money to spend on anything beyond necessities. They postpone buying anything that's not food, gasoline, and shelter. iPhones are not selling as good. I'm sure a lot of other discretionary spending is taking a hit, as we can see in the markets right now. So this is what's going on. Companies know that their revenues are not going to be as good because people literally don't have the money to spend on anything that's not a necessity. So the first thing you do in a sign of trouble, the first thing you do in a recession is you cut advertising budgets. You don't fire the salespeople. You don't fire the production workers. You cut down on advertising. We've seen that across the board for years and years, every single recession. So if Meta and YouTube at the same time simultaneously showing us that companies across the board cutting their budgets, while we know the flip side, which is people have an 86% drop in their savings at the same time, that's very indicative of what's about to happen. Now, there's two scenarios going forward here, and none of them are good for the economy. Inflation is at 8%. As you can see, the market is starting to send the canaries out of the coal mine, and now the Fed has a very interesting choice. So, 8% inflation with unprecedented, at least in recent history, hikes of 0.75, 0.75, 0.75, but still, inflation is way higher. In fact, 4 times higher than it should be. The normal rate is 2%. We're at 8%. So the Fed has two choices here. Choice number one is to go harder with interest rates. Go even more hawkish. Crush it right now. But the cost will be money that's going to be absolutely sucked out of the system, potentially a credit crunch, is going to be a massive recession. Going hard on interest rates, not only going to obviously have an impact on the US ability to service its own debt, which is a whole video I did on my own. That's a whole different crisis they're going to have to solve. They're going to do that. But even on the domestic side, the economy is going to take a massive hit if money becomes insanely expensive and scarce. We all know that. The flip side of it, which is the second option, there's no more options by the way, is that they just let it go. They find a way to pivot. Like Jeremy Siegel just said a few days ago, well, I think we should pivot. And he's a professor at Wharton. So there's a lot of voices talking about the Fed pivot. A pivot essentially in this case means that the Fed slows down. They say, well, we don't need to raise interest rates. Inflation is coming down. We're good. I'm going to tell you all about it, how it peaked at 9.1% in June, which it did. And just going to tell you, well, it's going to fix itself. Don't worry. If they do that, yes, we will have a short period of euphoria in the stock market. Make no mistake about it. But the end result is going to be that inflation is going to stay elevated, which means that the margins are still going to be eroding even more every single day, every single week, every single quarter. Because think about it this way. Companies that are just barely breaking even right now are trying to figure out what the hell do we do with this, right? And most of them are saying, well, let's give it another 3 months, 6 months. Let's see what happens. Let's just try to survive. If inflation persists for another 3, 6, 9, 12 months, these companies will have to cut into the employees. More employees will be laid off, which means less savings, less disposable income, less spending, which means even less revenues, which means even more employees getting fired, and a vicious cycle of a recession. So whatever you spin here, whatever options you look at here, a recession seems to be almost inevitable for 2023. Now, you can look at the GDP numbers and be encouraged by the growth, that's fine, but you have to be honest with yourself. There is no way in hell that Google and Meta, the monopolies, the duopoly in the advertising market, give you these results. That you look at the personal savings rate going down 86% in the last 2 years, and you don't say, well, hold on a second, something is going on here. I would just advise you to do your own research. And of course, I actually put out a whole video explaining how I'm going to invest when the recession hits and how I'm actually going to leverage the recession to actually make money. The video is going to be right here. Go check it out. If you haven't yet and you still want to subscribe to this channel after watching this video, you can do that right here. I'd really appreciate it. And of course, you're always welcome to hit the like button if you enjoyed this video. But as always, you don't have to click nothing. You don't have to smash nothing. Just thank you for being here with me. I'll see you tomorrow.